Hi, my name is Joe Henderson. Here is our portfolio project.
And my name's Nathan Duke.
Okay, so to start, we'll go over our stock data. We pulled in data from 20 different stocks on the stock market. And here we plotted out their monthly returns for the last 5 years. Um, then from that, we calculated the um, continuous returns here, as well as the excess returns. Um, And then we calculated the average of these returns as well as the standard deviation. Um, and then using that, using our excess returns here, we calculated uh, covariance matrix of the returns, which we used in order to calculate our optimal portfolio and weights here. Um, as you can see, um, we have our optimal sigma as well as our optimal return. Um, and that is based on an annual risk-free rate of 2%, which is shown as a monthly here because our returns are monthly. And then from that, we used the weights that we calculated to get the weights for each stock in our portfolio. Um, Here are the total weights, and if a weight here is negative, that means we're going to short the stock. And if it's positive, that means we're going to be long on the stock. As you can see, just a couple of these weights here. And since we have $10,000 to invest in our portfolio, we multiplied these weights out by the $10,000 number in order to determine what our investment would be, either long or short.
Yep. And then so using those, starting off with the matrix at the top, uh, that is using the excess returns from the stock data tab. Um, and we created that matrix. And then right below that, matrix L, you can see is those are just solid numbers, but that's because we had to create a new Excel file in order to use the Koleski function. Because since we are collaborating on the same Excel, we were not able to save it as a macro enabled file. So we just copied those numbers over hard coded so that we could continue on with the Koleski calculations. And then the matrix right below that is just the verification to ensure that the Koleski did in fact work. And as you can see, that bottom matrix there is equal to the matrix at the top, which is labeled S. Moving over to the right, you can see we have our 20 Z's using how we've done the whole year, using the norm S in for the random number. Um, and then you can see at the top there, the mu expected return, the sigma. That again is from the stock data tab. Um, and we also, according to the instructions, had to scale those. And so you can see to the right, we did go ahead and scale those as instructed. And then you can see using those scaled numbers and the z's, we calculated new z's that were correlated, um, and using the transpose function and mmult, you'll see those functions a lot used in these next few tabs. Moving on over to the right, we have if you move over past the correlated z's to the right, we have the simulated correlated returns. Those are also using the correlated z's as well as the scaled factors above, um, using the formula we were given in week 6. So we had those returns there. Uh, Scrolling on over to the right a little bit more. Um, past the correlated returns, we have excess returns. And to calculate those, we just compared the return that we had from the simulated correlated returns. And you scroll all the way down. Well, you don't need to scroll all the way down. We just took the average of the return, and that is what we did to get the excess returns. And if you keep going over to the right, we have matrix S there. Again, you can see the M moles, the transpose being used heavily. And that matrix there is, if you scroll all the way back to the left, it is very similar to that matrix S at the very beginning of this tab. Okay, and then if we move over to the paths tab, you can see that here are 20 stocks again. Using the Koleski numbers from the last tab, we simulated out all of the returns for the stocks over 5 years for all 20 stocks. Scrolling over to the right more, we were given our mu, phi, sigma, and then our delta t, which is averaged over 12 months. We were given those, and we had to simulate out the portfolio over 5 years, and we did that monthly. And then going into the portfolio return, we just use the sums of the stocks, got the returns, pretty self-explanatory there. And then in addition, the risk-free, again, using the random numbers. And then for our risk-free rate, that's where we had to use our calculation with all the mu, phi, sigma, delta t, as you can see above, using those formulas we were given. Then the risk-free and risky weight, those are, or the risky weight, and then the risk-free, the next two tabs, those are just, according to the instructions, us having to slowly move our portfolio more into the risky or the risk-free section. And to the right, you can see our returns there, increasing for the most part. And those are the total portfolio returns. Now, this next section here, we had to do a data table of 1,000 runs. And then here again is another data table with 1,000 runs, but this also shows each time period, each month. So there are a ton of columns. This is like at each month's return. And then we copy that. If you go to the sim result analysis tab, use that tab to find, if you scroll all the way over, we use that tab to get average, median, and maximum returns. And we showed the monthly returns leading up to the maximum, leading up to the final total at the bottom. And yeah, those are just the kind of summary statistics of notable portfolio runs.
Okay, so now moving into this very similar analysis, except for now the client is choosing to withdraw parts of their account starting when they turn 50 in order to get some cash in the meantime as they wait for their investment to mature there. So this is a very similar analysis here. Pretty much exactly the same, except for now we have a withdrawal amount here and starting you can see here starting at the age of 50, we're minusing off that withdrawal amount every month as a client would like to take out $5,000 a month. So that changes a little bit of the arithmetic here. So we did the same exact run table here and calculated the the returns for all the different months, but except now with that withdrawal. And then we use that to calculate the probability of the portfolio being over certain values here. For example, 500K, 1 million, 2 million. As you can see, this formula is referencing this total column here, counting up the amount of instances over the value of 500,000 in this case over the total amount of instances to find that probability. And then additionally, we use solver to find the probability, find the max amount that could be taken out for the probability of the portfolio value being over 1 million to still be at 20%. And we calculated it at around 11,533 there. And then moving into some of the dashboards we made in order to showcase our calculations here. We have one here with the initial weights for the different stocks, long stocks here and short stocks, and then the value that we would be investing. Short stocks here, this is the amount we would be shorting, and this is the amount we would be investing in the long stocks here with these slicers, so you can customize which stocks you want to look at. And then here is some of the outcomes that we showed earlier. This isn't without withdrawal, the medium outcome, the average outcome, max outcome. As you can see here, here's the total value, and that's how they progressed over time. Now moving on to our next dashboard.
Yeah, so here are a couple pie charts to show kind of our distribution among the stocks, both halfway through and then at the very end. As you can see, there were some specific stocks that were making up a large portion of both our short positions and our long positions, and they somewhat stayed that way. Among our randomizations, there were some varying results, but typically, especially for Eli Lilly at the bottom for our long positions, that was typically a very large portion of our portfolio. And then moving on to the last dashboard there. These are just a couple from our example run with the withdrawal paths, just showing our portfolio value over time and also allowing you to choose ages. And then given that 500,000 or given that 5,000 withdrawal starting at age 50, showing some of the probabilities of reaching these specific thresholds of 500K, a million, 2 million, and so on.
Thank you.